Listen, a couple things we want to talk about today. First off, the stock market just keeps going. People keep saying, well, gosh, Michael, you keep saying that the stock market is at risk, and it just keeps making these enormous gains. Yes, it is at risk. One thing about being older is that you can look back in your life and say, gosh, I've seen this happen before, and I've seen this happen before. It is very, very reminiscent of the last 2007, when we topped out. I think it was in 14th of December 2007, and it peaked. And right before them was just euphoria. Everybody was just wonderful. Everything was just great and dandy. Everything was doing really, really well. Very, very similar to this. And also today, I read on that Morgan Stanley, who's a huge investment bank, has taken their private wealth individuals, so the private money, and they're 100% out of high yield bonds. 100% gone. I think the risk is way too high. So they've run out all of the profits that they think that they can take, and they've closed it out. So I'm not quite sure how they're reallocating. They probably just went to cash. But when you see that, you have to understand that things are changing. And the people that are in the wealth position, institutional money, has been selling. And if you look at the advertisements, you're going to see a lot of younger people coming on saying that, gosh, we think 2018 is just going to be a great year, that everybody should remain fully invested. Well, that's for the retail crowd and for younger people. And they're out trying to get the last people in, because remember, the private and wealth individuals have to sell to somebody. So these stock certificates are certificates that, so if I own it, I have to sell it to somebody, and they're getting the last of the people in right now. So these would be very, very much concerns for me. So I have talked to a lot of my clients, and we are going to. They've asked me what about when I say safety boat, a lifeboat. We're still selling some properties that we think would be marginal properties. So anything that we have in our portfolios that's marginal, things that is getting to the point it needs to be refurbished. And keep in mind, these are rental properties. So people, it's like having a fleet of rental cars. People aren't as careful with the rental cars as they would be with their own. So they get nicks and things, and we have to replace tires and batteries, and dishwashers and garbage disposals. We have to paint them. So, and sometimes we get around to some magic numbers like year 11, 12, 13, 14, 15. Just about a lot of things need to be replaced. You need to be looking to replace some appliances. You need to be looking at garbage disposal. Some plumbing fixtures need to get done. So generally, they're a major upgrade. So if we're either have to get into the point where we don't want to put this money in, or we don't like it, we're selling them. And we think we've gotten very, very good peaks on the residential. Here in Maricopa County, why we're the number one growth market in the United States, we've done very, very well, and we're ringing the bell. Now, when I say we're ringing the bell, we're going to cash on a lot of these. So we're just going to a cash position so we can have some money available for opportunity. And when I say that we have a lot of risk in the stock market, that's what I'm alluding to, is that, if you put $1 million in the stock market 10 years ago, and you now have $2 or $2.5 or $3 million, I guess I'm advocating that you think maybe you should take half off the market. Maybe you should take your original investment back. And say, look at, I have nothing but my gains. So I've got my original money back. The original nest egg is back. Put that into cash. Or start thinking that maybe you want to put it into another asset class, because that's what we're doing. All my clients do not have all of their money in real estate, but we have a good portion of it because we're in an incredibly compelling marketplace here, and we're income investors. And a lot of people I deal with are really need income. Now, so if you need income, then you're kind of forced to move from a non-income bearing, like the Standard and Poor's, the S&P. Currently they're at 1.78% return, dividend. So last year was like 1.76. So they've grown the dividend a little bit, but it's still, only 1.78%. We start at 5. So those people who need income, look at, it's nice having $100,000, $200,000, $300,000 in income coming in. You can spend the income guilt-free. Spend the income. You just never spend your capital. So if we have any kind of a downturn in the economy, you're going to be forced to spend your capital, and that's just not good. So people are switching from one asset class to another. But we'd like you to have some cash, because we are, if the scenario plays out like I think it will, then you're going to have some really good opportunities to buy some incredible properties at a discount. And we're looking for the real estate market is going to be like the stock market here in like 7 years. So we expect it to do the same thing. It's going to spike. It's going to spike, which is what the stock market is doing now. It's spiking. So you should be taking money off the market when you get a spike. And the stock market is certainly spiking now. It's going vertical. So you still want to have some money in there, but you want to be very, very careful with that. And I would be taking some money off and reallocating, either going to cash or reallocating. Now, people who are my age, they're looking for income. So you have a couple of choices. You can either stay in cash, but it doesn't generate any income. So if you need that income, then maybe you should go ahead and purchase property, because we can get you 5%. Pretty much 5%. So at 5% versus 1.78%, we're better than 2.5 times what you can get in the S&P. And quite honestly, our gains have been probably better than the S&P. So we'd have to sit down and go over that with you, because most people don't believe it, but it's true. So we can get you probably double, sometimes even triple the income that you're getting on a Standard & Poor's, which is very, very important for people my age, because we want to have that income coming in. Now, people that aren't my age that are professionals and are in a economically sensitive business, if you're in the mortgage business or banking, or if you're in car sales, these things are economically sensitive. So if the economy slows down, it's nice to have an additional source of income. And this is what we're saying, is that you can have your investments give you income. And so a lot of our clients need that income. So we've been helping them get that income. But we also want them to remain really, really safe. So we're not using every last nickel and dime into the markets. We'd like to see some kind of a cushion. We'd like to see reserves, some opportunity money that you can deploy should you get some really good opportunities. And if you really are honest with yourself and look at the stock market, you can say, how much opportunity do you think is here? Is this going to go up another 50%? Is it going to go to 40,000? Who knows? These things go until they don't. You could wake up tomorrow and be down 500 points, and then you're going to be really sorry. So I guess that's what I'm saying, is don't be sorry. Keep a little bit in there, but take your original money off the market. At least go to cash. I'd like to see you start getting some income into some of these income properties that we have. But we're here to help you. We'll help you any way we can. So my very, very best to you. And if there's anything we can do for you to make this a very healthy, happy, prosperous New Year's, just let us know. My best to you. Bye-bye now.